Let's talk about overextended gap down. This pattern has been around since 2015. It was originally Tony was using it many times, many years ago, and this pattern has been lasting for a couple years now. I have discovered a bunch of problems with this pattern, so I have narrowed down the criterias and make it has more winning percentage, but definitely if you make it more strict criteria, it will definitely drop the frequency. It only happens between 30 to 50 times a year. It used to happen 70 times a year. The winning percentage is around 70%. This really depends on the market cap zones and what type of flow you're trading. So let's get through all of the criteria first. First of all, your main focus should be the market cap under 200 million. The flow is under 25 million. If the market cap gets too big, overextended gap down does not work. If the flow is too big, that means the stock is not going to push because the flow is too big. Typically, overextended gap down on the second day only trades less than 10 million volume. So second criteria is the minimum spiking percentage from the previous day has to be 100%. At very least, if it's up less than 100%, does not qualify as overextended gap down. I see a lot of students that are thinking overextended gap down, they saw a previous day ticker is only up 70%. Number three is the minimum 3-hour consolidation is needed for the first green day. If it doesn't form any type of consolidation, if it gaps down the next day, it does not qualify as overextended gap down. So remember that you need consolidation to qualify this pattern. If you don't have consolidations, this pattern is useless. Number four, gap down range has to be between 5 to 15%. If the ticker gaps down more than 15%, you are likely to reduce its winning percentage, because if the ticker gaps down, let's say 60%, then every buyers will lose faith. They will not buy at the open. So the stock will likely to push into the consolidation, or you push just maybe 1 or 2% and just straight dies from there. If the gaps down less than 5%, then it's not an overextended gap down anymore, because if it gaps down less than 5%, 1 or 2%, it can be easily popped back up by some manipulations from market makers. So less than 5% does not qualify as overextended gap down. Last point is dollar block. The dollar block for that 3-hour consolidations has to be minimum around 100 million. So how to really calculate dollar block? It's basically are using the consolidation average price, which the fluctuating range cannot be over 20% for the stock price. So that consolidation fluctuating range has to be within 20%. Another one is the volume within that 3 hours has to be at least, if it's a $3 stock, then the consolidation needs to be 30 million. Typically, you trade overextended gap down pattern with average stock price between $5 or above. Under $3, overextended gap down doesn't work that well. So your price range is between 5 to 15. Let's talk about overextended gap down winning percentage factor. Those are some criteria that will likely to affect your winning percentage. First one is the longer the consolidation, the better for you to short. Of course, the longer the consolidations, the more back orders there will be, and the stronger the resistance is. That means more dollar block. So that's pretty obvious. Second one is do not short at the open. I see a lot of people shorting at the open because they're not patient to wait after the push, because there's one of the common scenarios they run into is if the stock is qualified as overextended gap down, typically they will run into SSR. So SSR ticker always pushes after market open. So if you don't wait after market open, they push 15%, you are down 15%, then you cover and then stock drops. So it goes the opposite direction, whatever you do if you short at the open. Be very patient, wait until the first 30 to 45 minutes before you take a position. Number three is the volume ratio needs to be at 5 to 1. That means if yesterday trades 50 million volume, today it needs to trade 10 million volume. If it's 100 million volume, it needs to trade 20 million volume. Then if the ratio is 10 to 1, typically it's great for shorting, but always take into the considerations that you need the liquidity to size in. If yesterday only trade 10 million, today is only going to trade 1 million, then all of a sudden you have no volume to be sizing into. And that's somewhere you want to be really careful with. If you're sizing way too much, you're likely to just play yourself because there's nobody going in that much, and you are exceeding way what the pattern can take or can offer to you. So do not, as I said in the previous slides, do not exceed over 1% of the volume, do not exceed over 1% of the float. Second one is typically low liquidity do offer really aggressive spikes. Always wait till volume to come in first. When the market opens, if the pre-market volume only trades a couple hundred K volume, that means throughout the day, you're only gonna get 3 to 4 million volume. Then if you size into low liquidity, then after that, stock performs really aggressive spikes. That's where you are likely to get stopped out or hit your max loss. Always wait until push, wait until volume to come in, short into a strength, and that's very essential. Next is wait for consolidations. So for a lower float, typically then when the stock pushes, it doesn't form consolidations. With higher float, typically it does. So this is where it's up to you to track your own statistics to see, okay, well, some of the consolidations only forms on higher market cap, some of the consolidations only doesn't really form on lower market cap. Now for nano float, sometimes goes into halt, then as soon as it opens, it drops another 15%. So that's very important for tracking specific market cap zones and flow zones for yourself to recognize some of the spikes are more aggressive on nano float, some of the spikes are less aggressive. For micro float and nano float, for especially using overextended gap down, it will significantly reduce your winning percentage. And also by using it on nano float, first of all, when the stock is on SSR, on low liquidity, that means the spike are already aggressive enough. Plus, the nano float typically offers with really large spread. That means bid and ask are far from each other. Whenever you are shorting or buying it, you're not going to get the execution price you typically want because they're so far apart. That type of scenario will likely to shake out your max losses. So always be really careful if you want to sizing overextended gap down, nano float and micro float, make sure sizing is small because the winning percentage are not high.